Hey, and welcome back to another Skag Academy video lesson. In today's video, we're going to discuss candle theories. We're going to take a look at two different tips that I have for you regarding candlesticks. Now, these are simply theories, which means there are situations where these don't always kind of pop up. They don't always make themselves relevant to current market conditions. We'll discuss a little bit of that as we, kind of go in depth with them. But I do want to kind of make it clear that these are theories. They're things that I've personally noticed on the chart. They're not law. It's not like law of supply and demand or the law of effort, but they're just these little things that make, executing and managing your trades a little bit easier. They give you more clear defined rules for entering, more clear defined rules for targets, whether or not you should believe certain things that you see. So let's hop right in. The first one we're going to take a look at is the theories around Wicks. Now, a wick is typically associated with some sort of reversal pattern, which can absolutely be true, and for a lot of situations will be true. However, like order blocks, right, these are going to be greatly affected by the location of them, right? So depending on where these wicks are in terms of the overall cycle, right, whether they're a phase A, B, C, D, or E, right, whether accumulating or distributing, where you are in that trading range, the wicks are going to respond differently, and you're also going to use them differently. So, for example, a typical reversal wick, right, which is basically a wick that is left mostly untested, mostly unfilled, price doesn't really revisit that area again, are usually found in the, phase C environment where we expect price tests to be final. We don't really expect price to revisit that area a bunch of different times. Now, a momentum wick is a wick that we typically expect to be filled, right? And these are found almost everywhere else, to be honest. These are actually more common than an unfilled wick. Most wicks, whether it's immediately on the next candle or later in a different session, will usually get filled. So these are going to be more common in practice. Right, so we're going to take a look at some examples, but before we do that, I want to just kind of show you the difference on the right side here. Out of those two things, those two chart patterns, the one on the left is an example of that reversal wick. We can see that price wicked to the upside, and then the following candles are very aggressive in the opposite direction. Right, this is that kind of phase C environment wick. And then in the second example there, you can see we have a harsh move to the downside, which left price, with that wick on the bottom, and then price kind of redid its thing. It actually sat there, created another redistribution cycle, and then eventually came down and filled that wick. Now I want to show you these in the actual market. This is just taking a look at Bitcoin. This is one of the cycles that it was going through. This is actually pretty recently as of recording. So if we kind of just take a look, we have a phase A, B, C, D, and then further down E environment here. And if you take a look right here in the phase C, this is where that untested wick kind of comes into play, right? We see it pushes up into the phase C. This is a type 2, technically a redistribution. So type 2, there's no spring, no push outside of the range. We get that wick, and then we get the immediate price action after. And then you can see where the momentum wick here is after that phase C environment in that phase D, where we expect price to kind of be trending. This environment leaves that wick being filled. And if we just look at all the other wicks after this phase C, right, everything gets filled. You could see there's some wicks with inside here that may suggest that there was, some sort of rejection or exhaustion or possibly reversal, and then they just get filled, right? Leaves a wick, in a pretty good zone, right? You're creating equal lows, you're hitting areas of demand. The wick is fully committable, right? It makes sense why you would get some signs of rejection here, but as the market works out that supply and demand, that it worked out from up here, you just get that continuation. It fills. Again, look, wick, 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 wick. There's like 6, 7 candles, all with wicks to the down on the downside, right? Possibly suggesting that price will pull back, right? That's what kind of you're normally taught, that these wicks show signs of rejection, possible reversals. But as you can see, all of these fill all throughout. You can even see some of the phase A and phase B wicks get tested, like this wick in phase B here, right? This doesn't get fully filled, but the wick from phase C does fill in some of that price action. Phase A, all wicks got filled. You can see it's a little bit just choppier of a market. There's no real reversals from these wicks. Yeah, there are reactions, but price doesn't substantially move down in any way. And yes, you could say that the wick in phase B, maybe you could have played that. It did play out for some time. But again, because it's not some sort of phase C or even possibly phase D environment, right? The momentum was not fully there, and it did get partially filled. So just kind of understand that as you're looking at markets and you're in trades and you're getting trade management, like if you were short from this phase C and you see this wick, it's not an immediate sign that price is going to reverse and then you have to just exit your position, because just a day or so later and price is already filling that wick and moving down. So I kind of want to just kill that idea that wicks automatically mean reversals. If anything, you should expect most wicks to fill. Even if you were looking at this as an area of demand, it is more common that the second candle comes down and refills most of this wick. And if it does close up, there might present opportunities, but the original wick will usually fill. So that covers some of the wick theories. Again, I just want to kind of break that, standard thinking that all wicks mean reversals. Because if you trade that way, you're going to find more times than not the market's going to come back for you. So let's talk about another one. This is something that I use a lot personally, especially with trade management or executing, as you're going to see on live OBs. This is something called open against, close away. So again, this theory is more centered around trade management, but it also applies when taking a live OB trade, which is something that we discussed in the order block lesson. So go back if you need a quick refresher on that. The idea here is that we prefer to see a new candle open and move against our trade direction, so it has a higher probability of closing away, right? So I can't really demonstrate this without, actual video of it happening, and I will definitely try to get some examples of that for you guys on video. But the idea here is that when you're looking to take a trade setup, and in this example down below here that I kind of drawn out is using 5-minute candles, right? So let's just say this is 8:59. You have this bearish candle here. Let's just say this is sitting inside of a liquidity zone. All right, you have everything you basically need to execute on, but you're kind of just waiting for this live OB. At 8:59, you're looking at this bullish candle. This thing is going to close, bullish. It's going to have the engulfing. It's going to be in the liquidity zone. There's going to be, it's going to be a phase C environment, let's say, or even phase D. Right, we already have the end of our cycle in play. And then 9 o'clock rolls around and it ticks over and we open up a new candle. And the first minute or 2 minutes from that candle, right, we immediately get a push against us. Remember, we're looking to buy. The gray is our sell candles. The blue is our buy candles, just like on my normal chart. Right, so the new candle opens. We get the live OB. We want to play this. And immediately we want to see is this candle open against us, right? We want to see it come down. And the main idea with this, again, is because one, it's pushing into the OB, which gives us our, entry price. So we always want to see that. But as this candle develops, right, you'll see that just because it opens against us, right, there may be, and this is not always going to be the case, but there usually is a higher probability that it will close away, right? We're basically saying that we want it to open against us so it can start forming the future wick, right? This is 9:02, 9:03, that new minute candle opens, we start to push up, right? Starting to close away from the direction that we're trading. And then by 9:05, you'd want to see something like this. And this is applicable to literally any time frame, right? If this was 8:59 and these were hour candles, great. Maybe this is what it looks like by 9:15, 9:20, 9:25, early on in that hour candle. Right, maybe this is what it starts to look like at 9:35, 9:45. Maybe by like 9:55, 10 o'clock, it starts looking a lot more bullish. Right, again, this is not strictly speaking necessary. Right, if you're already in your trade and price has kind of moved away from it, and there's a new hour, you don't have to be on top of it all the time. But when you're live executing or live managing a position, this is something that's always in the back of my mind. Right, if we take a position at 8:30 and then by the time 10 o'clock rolls around and we get a new 4-hour candle, right, I want to see that 4-hour candle kind of pull back, right, pull back towards my entry. This way it can start working out that supply and demand and begin to close away from my price and remain looking strong. Again, this is not something that's always going to be the case. Sometimes you're going to have candles that immediately just open up and they run higher, they test down a little bit, they continue higher, whatever it may be. Now, the reverse of this is also possible, right? If it opens away from us, there's a good probability that if it never tested down, that it's going to come back and test to the downside. Now, You can manage this a bunch of different ways. We'll go over trade management in a different section, but this is just one of the things that I'm constantly looking for when I'm in that execution mode. So as you're beginning to look at like executions in phase C environments, springs, start to see if you notice this. Start to see if you see, candles opening up against you, closing away, and you'll begin to, see how you can kind of play that. The live OB is something that you have to really just get used to playing. This is typically what it looks like on any time frame when it works. So that being said, guys, those are the two things around candle theories that I wanted you to have an open mind about as we go through the execution tactics. If there's any questions, comments, concerns, ideas, again, throw them in the comments below. Let me know in Discord, and I will see you guys in the next lesson.